Imagine this. Yesterday, a massive household name company saw its stock jump 15% without opening a single new store or releasing a single new product. Meanwhile, on the exact same day, another company reported absolute record-breaking sales. I mean, literally the most money they have ever made. Yet its stock completely plummeted. Well, welcome to This Explainer. I'm so glad you're here because today we're going to unpack exactly why this happens, how this entire system works, and who actually decides what a stock is worth. Honestly, the answer might completely change how you think about investing. So if you're new to investing, you probably have a very logical assumption, right? If a company makes money, the stock goes up. If a company loses money, the stock goes down. Makes perfect sense. But as we just established with that opening paradox, it is absolutely not always true. We are going to solve this exact mystery today, because once you understand why a highly profitable stock can suddenly nosedive, you essentially unlock the secret to how the entire financial world operates. Okay, the core thesis of this entire explainer is actually pretty simple. The stock market does not trade on the reality of the past. It trades on the expectations of the future. When you look at a stock ticker flashing green and red all day, you aren't just looking at a company's past performance. You're actually watching millions of buyers and sellers constantly reacting, adjusting, and betting on what they expect will happen tomorrow, next month, and next year. All right, let's dive right into this with Section 1, the ultimate pricing engine. So the main purpose of a stock exchange, like the New York Stock Exchange or the NASDAQ, is to provide something called liquidity. Now, imagine owning a house in a town where absolutely nobody wants to buy houses. You might own something incredibly valuable on paper, but you can't actually convert it to cash. Liquidity solves that problem. A stock exchange is essentially a giant high-speed auction connecting people who want to buy with people who want to sell, and it ensures that you can get in or out of a position almost instantly. And because it's an auction, the ultimate force behind all stock market movements is just basic supply and demand. Every single transaction has a buyer and a seller. If there are way more buyers demanding a stock than there are sellers willing to part with it, those buyers have to compete. They're forced to offer higher and higher prices to secure those limited shares, which drives the price up. Conversely, if a wave of panic hits and everyone wants to sell but nobody wants to buy, well, sellers have to slash their asking prices to find takers, driving the price down. It's really that simple. Which brings us to Section 2. Reality versus market expectations. Now, the fundamental value of a company is heavily tied to its earnings or its profits. Public companies are legally required to report these numbers every single quarter, and Wall Street absolutely obsesses over one specific metric: earnings per share, or EPS. This is just the company's total profit divided by the number of outstanding shares. Since you, as a shareholder, own a piece of the company, EPS essentially represents your specific share of the profits. Higher EPS is always better. But here is where it gets incredibly tricky. This perfectly solves our opening paradox. Let's say a massive tech company just reported $9 billion in pure profit for the quarter. That is a staggering amount of money, right? In reality, the company is wildly successful. But if the street expectation, meaning what Wall Street analysts and investors had predicted and already priced into the stock, was $10 billion, well then that incredible $9 billion profit is actually considered a miss. Because the stock's current high price was based on the expectation of $10 billion, the market instantly and aggressively sells the stock to adjust to this new, slightly less optimistic reality. And, earnings reports are just one type of catalyst. A catalyst is basically any event that triggers investors to frantically buy or sell, updating their expectations. It could be a huge tech company unveiling a groundbreaking new smartphone or a brand new electric car. On the flip side, it could be an unexpected lawsuit against a pharmaceutical company, a surprise CEO resignation, or even a massive merger. The market is constantly digesting this news in real time, instantly shifting supply and demand and adjusting the fair value of the stock second by second. Let's zoom out a bit for Section 3, how interest rates move markets. Let's walk through this economic cascade step by step to see why the whole market often drops all at once. When inflation gets too high, central banks, like the Federal Reserve, step in and raise interest rates to cool the economy down. Step 2, suddenly, taking out loans becomes way more expensive. Step 3, because borrowing is now so pricey, companies stop expanding, they halt new projects, and their profit margins shrink. Finally, Step 4, investors see the slowing growth, they pull their money out of the stock market, and they move it into safer assets, like government bonds, that are now paying higher interest. The entire stock market can drop, even if individual companies are fundamentally doing okay, simply because the cost of money changed.
And that leads us perfectly into Section 4, Investor Psychology and Emotion.
The dreaded bear market. It's a sustained period where stocks drop 20% or more. But bear markets aren't just driven by math, they are heavily driven by FUD, fear, uncertainty, and doubt. During periods of volatility, human emotion completely takes over. A totally normal market correction can snowball into a terrifying crash simply because investors see red on their screens, they panic, and they hit the sell button, which of course drives prices lower, which then causes even more panic. It's a vicious psychological cycle. So let's rapidly break down exactly what causes this irrational behavior, because you absolutely need to recognize these in yourself. First up is loss aversion. Research actually shows that the psychological pain of losing $1,000 feels nearly twice as intense as the joy of making $1,000. This causes beginners to panic sell at the absolute bottom just to stop the bleeding. Then there's herd mentality, blindly buying a stock just because your friends or social media are hyping it up. Next is overconfidence, where people trade way too frequently thinking they can perfectly predict the future. And finally, anchoring bias, where you stubbornly refuse to sell a failing stock because you're rigidly fixated on the all-time high price it used to be at. These sudden spikes in human emotion regularly disconnect stock prices from their true fundamental reality.
So, how do we handle all of this? Section 5, Navigating the Noise.
Look, if you take one single thing away from this explainer, please let it be this. In the short term, stock prices are wildly unpredictable. They are driven by headlines, emotional noise, algorithms, and panic. But over the long term, we're talking years and decades, the price trajectory of a stock eventually aligns with the actual fundamental financial success of the business. A great company will eventually see its stock price reflect its greatness, regardless of any temporary panics along the way.
If you are terrified of crashes, looking at historical data tracking the market since 1932 really puts things in perspective. Yes, bear markets are scary, and they drop an average of 35%. But they are short, averaging just 1.5 years. Compare that to the massive bull markets, which last an average of nearly 5 years, with cumulative gains averaging a staggering 177%. To put that simply, historically, market resilience and growth periods absolutely dwarf the temporary panics. Ultimately, the market wants to go up. But to actually capture that growth, you can't run away when things get scary. If you stayed fully invested over the past 20 years, your returns would be incredibly strong. But if you panicked, tried to time the market, and ended up missing just the 10 best trading days over that 20-year period, your returns plummet. It's a massive reduction. And here's the real kicker. The market's absolute best, highest gaining days historically happen almost immediately after its absolute worst days. Panic selling literally locks in your losses and guarantees you miss out on the explosive rebound. This brings us to a stabilized, absolute truth from our sources. Time in the market, not timing, is critical for long-term investment success. No analyst, no trading algorithm, and certainly no financial guru on the internet can perfectly predict the short-term peaks and valleys. But by investing consistently, ignoring the daily noise, and giving your assets time to compound, you leverage the overarching upward trend of global business growth. So let's bring it all full circle. We started this whole thing with the mystery of a stock dropping despite record profits. So when push comes to shove, who actually decides what a stock is worth? Well, it's not a single person sitting in a boardroom. The stock market is a massive, living, breathing ecosystem. It is millions of institutional computers, retail traders, and fund managers constantly negotiating the exact fair value of an asset every single second of the trading day. They are constantly weighing with cold, hard math of earnings and interest rates against the incredibly unpredictable forces of human fear, greed, and future expectations. It is beautiful, it is chaotic, and frankly, it is the greatest wealth-building machine ever created. Now that you understand the mechanics pulling the strings behind the scenes, the major difference between reality and expectations, and the very real danger of your own behavioral biases, the ball is firmly in your court. The next time the market drops and the headlines scream panic, will you sell in fear, or will you recognize it as just short-term noise on the path to long-term growth? Thanks for joining me on this explainer. I really hope this helps you navigate your financial journey with a whole lot more confidence. Keep learning, stay focused, and I will see you in the next one.